Hi, my name is Eli Katz, and today we're talking about investing. In 1984, this dollar could have gotten you 2 shares of Apple. Today, those shares are each worth $100. This is investing, and anyone can do it. So what does it mean to invest? Well, the basic definition is when you put money in to get more money out. There are many ways to invest. For example, when a farmer buys seeds for his farm, he invests his own money with the hopes of making more money from selling those crops. When people invest in a business, they hope to make money from the business's success. If done right, a lot of money can be made from investing. Warren Buffett, one of the richest people alive, was able to amass a fortune for himself by making smart investments in businesses and then hoping that those businesses grew. But before we talk about how to do that, it is important to understand how one can invest in the world of business. There are many ways to invest. You can invest in bonds, mutual funds, options, futures, or real estate. The most common investments, however, are stocks, also known as equities. Put simply, when you buy a stock, you are essentially buying partial ownership of the company, taking on its risks as well as its rewards. In order to understand this concept a little better, let's go back to the first time stocks were ever used. In the 1500s, ambitious groups of explorers wanted to charter trips to explore the world with the goal of making lots of money. In order to fund these trips, large groups of people pooled their money together, paying for shares or stocks that certified their partial ownership and consequential right to any profits of the ventures. This practice quickly spread throughout the world. Over time, businesses began issuing stocks to the public to raise even more money, forming the stock market we know so well today. In summary, businesses offer stocks in order to raise money to spend on bettering the business. Some businesses, however, prefer to remain private, like the ones you see on Shark Tank. In these situations, the owners prefer to hold on to the ownership themselves rather than give it out to the public. Now that we know why businesses like stocks, let's dive into how investors use stocks to make money. First, let's get a better idea of what a stock is. Stocks have constantly changing prices, which is what allows people to make money off of them. A company's stock price generally represents the company's value. The question is, where do these numbers come from? Truthfully, there is no right answer, but there are 2 prevailing theories. The first centers around the idea that every company has a value. The value of a company is calculated by all the stocks or shares added together. For example, if you have a company that issues 10 shares in total for $10 each, the value of the company will be $100. A company's value is also called its market capitalization. A smaller company will generally have a smaller market cap than a bigger one. The theory is that as a company's market cap changes, so will its stock price. The second is that stock prices are determined by supply and demand. The higher the demand, the higher the price. Here's some of the ways you can make money from stocks. 1. Dividends. Because ownership of a stock is the same thing as owning a part of a business, it makes sense that ownership of a stock entitles you to a portion of incoming profits. Some companies choose to pay this portion to their investors through what are called dividends. Say I own 10 shares of Microsoft. Each one cost me $51. Microsoft happens to offer a 2.82% annual dividend per share. That means that every year I get 2.82% of the stock price. So at a price of $51, I would get $1.4 back just for owning the stock. Because I own 10 stocks, I'm getting a $14 paycheck every year. As a company grows, its market cap will grow with it. As a company's market cap increases, so will its stock price. Take Apple, for example. If you were to find it before there was an iPhone in everyone's pocket and waited 30 years for Apple to ripen, you could have made bank. 3. Volatility. As you saw in the graph, the price of a stock fluctuates wildly. If you are able to buy it here, you could sell it here and make a few bucks. This risky method of stock trading is known as short-term trading. Don't treat this like gambling, or else you'll lose lots of money. Good short-term traders wait for a stock to reach a low point, then decide if a lot of people want to buy the stock. If it appears that a lot of people want to buy it, so will the investor, because the stock's price depends on demand and will probably go up. Investing is an available and accessible tool for anyone to make money. But before you blindly jump into the stock market, make sure to get your feet wet a little by using one of the following platforms to simulate the stock market with virtual money. Thanks for watching, we really appreciate it. If you found this video interesting at all, and I mean at all, feel free to share this with your friends, family, and pets, as we'd like to reach as many people as we can. If you have any questions, leave them in the comments. But right now I have a question for you. What's your favorite ice cream flavor? Leave your answers in the comment section below. This has been Eli Katz, and until next time, stay interesting.